Hello and welcome to our 10th episode of Your Money Life Coach on eRadio with me, Barbara Mandel. This is your weekly Wednesday inspiration to act and manage your money better. Today we'll be discussing the different types of retirement funds and what the budget impact was. Now, if we look at our typical retirement landscape, we've got various savings options. One of these options is to save in a retirement annuity, a pension or provident fund that is done through your work. Now, with the changes that was initially proposed by government in 2016, the government aimed to help people save better for retirement, and there were certain limitations and certain benefits in doing so. So typically how a retirement annuity and a pension fund used to work is that you would get a tax deduction while you contribute towards those retirement funds, and at the end of your term, when you have to retire, you can withdraw 1/3 of that funds, and then you have to invest 2/3 of that to buy you a monthly pension. Now you've got two options when you do that. You can either invest in a living annuity, which means that you determine the drawdown and the income that you want, or you can invest in a life annuity. Now a life annuity comes with certain guarantees, and it helps the insurance companies to give you a rate by what they call underwriting processes in some of them. So they determine how old are you now, look at the money you've got, and then say, for this amount of money we'll provide you X amount of income. Now the main difference between a life and a living annuity is that when you die, whatever's left in your living annuity pot, you can then give to your beneficiaries. With a life annuity, sometimes there are a certain portion of your capital, but in majority of instances, majority or all of your capital will then be used by the insurer because they are taking a risk in guaranteeing your income. So then the opposite is also true. By taking a life annuity, you are guaranteed to have an income for life. With a living annuity, however, that risk falls on you to make sure that you don't draw too much of that money and that it grows adequately in order for you to have enough retirement savings. Now, if we look at the major changes that was introduced in the budget. Now, when government originally introduced the changes, they said, right, we want all retirement funds to work the same. And there was some pushback from the unions. So typically when people resign, they are able to then take out their full funds, and it caused a bit of issues because the whole idea behind giving you a tax deduction was to say that, listen, we want to encourage you to save for retirement from government side, because then they'll have less people on an old age SASSA pension. So by doing this, unions were up in arms. They didn't agree, but they have finally agreed. So going forward, all new money that you'll invest, so the old money you'll still be able to withdraw if you're in a provident fund at retirement, but all new money of this retirement fund, or your provident fund especially, will then go into a pot where you will also be forced to take up to 1/3 maximum up front, and then 2/3 you have to buy either that life or living annuity. So is it a good or a bad thing? In my opinion, it's a good thing because it encourages people to save for retirement, and it allows people to now have better control over their planning. The biggest problem was most people would withdraw their retirement funds, pay a hell of a lot of tax on it, and thus reducing or losing the tax benefit they had while saving for retirement. And in the end, because they had access to the money with no restrictions, by 10, maybe in some instances 2, 3, 5 years later, all that money would be gone. So people didn't have any access to that funds. You'd also find that typically people would also resign just to get access to their retirement funds, especially in some instances to settle their debts, or they find themselves in a precarious financial situation, and they would then use that to get them out of it. Now, if you retire from your fund, the new tax rules will apply. If you resign, or you are retrenched or you are dismissed, you will not be subject to purchase a pension, and you've got the option to take your funds. But now here comes the tricky part, and that goes for all the times that you are changing your jobs. there's a whole debate about preserving money and how do we get people to preserve more of their money. So when I resign and I want to take out my pension or provident fund from my company, there's quite a heavy tax burden on that. And the reason for that is government is trying to incentivize you to rather leave that money in a retirement vehicle, because then you've got limited access to it. So it's like a retirement annuity. Most people complain that they take out a retirement annuity and when they need money, they can't access it. Remember, by law, you cannot access the funds in a retirement annuity before the age of 55 unless you have resigned from citizenship. In other words, you have emigrated. So, and that's also not changed with a lot of the regulations, and we'll do a future episode on that. But currently, I just want to focus on that retention of your funds and saving that to make sure that you've preserved and planned for your retirement. I also just want to say to people that when government make changes like this, it's not always welcomed initially, because we're trying to as human beings hold on to the little power we've got. But we must also realize that we live in a world of needs and wants and demands, and people often find themselves in precarious financial situations, and government has to protect its own assets in terms of the state so they don't have too many people relying on them in their old age, as well as incentivize us on how to better manage our money. I also just want to leave you with a final thought. You should never have all your retirement savings in a retirement fund. It's ideal to consider the use of a tax-free savings account, which can boost your retirement. And we'll discuss that next week. So that's it from me today. I hope that you've enjoyed this episode and that you found it valuable. If you've got any questions, please remember to reach out to me on Your Money Life Coach on Facebook, or you can visit our website www.yourmoneylifecoach.co.za. Thanks for listening, and I hope to see you next week.